First of all, for those of us who only sometimes follow this, remind us what these proposed regulations are. They're supposedly having to do with reserves related to Basel III. What do they say as they're currently proposed, and how much of it is required by Basel III?
So this is, to put it mildly, an extraordinarily complex issue. Basel III is the global attempt to establish capital requirements. And at this point, the U.S. is the one country that has not yet adopted what is referred to as the Basel III Endgame, the end of this entire capital effort. So what do the U.S. Proposed rules require? I think cutting to the bottom line, the Federal Reserve estimates that the capital levels of the banks subject to this rule would increase by about 16%. Trade associations estimate 20%, and both of those are averages. So inevitably, there will be banks with more than that 16 or 20%. So it is a really big deal, that type of capital increase.
I wonder about the people involved in this decision, Raj, because I read last year that Jamie Dimon was urging other bank CEOs to talk not to Michael Barr, but to Jay Powell and other people on the Fed board. I think I read also in either Barron's or the Wall Street Journal that Martin Gruenberg staying on at the FDIC was an important decider in which capital rules go into action. Who are the most important people that we should be watching?
Well, I think the effort is being led by the Federal Reserve, but they are going to want to get the other two government agencies, the prudential bank regulators involved, the FDIC and the OCC, but it is Federal Reserve led. And Jamie Dimon's comments have been echoed by a concerted effort, not just with the regulatory agencies, but in the halls of Congress, in the media, and with the administration.
And all of those comments are apparently having some effect. We've heard from Michael Barr, the vice chair now, that we should expect broad and substantive revisions to the proposals. From your following of it, what do you expect really to come out?
So I agree that there will be substantial revisions, and those will be in the component parts and therefore in the overall outcome. But the agencies have a real dilemma here. Number one, they can simply adopt a final rule. That is susceptible to legal challenge because significant changes typically require a new proposal, not just adoption. Or they can repropose, but that requires substantial time, probably delays a final rule until 2025. If I were a betting person, I'd take the latter, a reproposal, because I think the changes will be so significant, but it's probably not much more than a coin flip.
I think it's so interesting, the bank landscape in this country, because we have 4,000 or 5,000 banks in the U.S., but most of the assets are consolidated at the big banks. I think 4/5 of all the assets are consolidated at the big Wall Street banks. If we get higher capital requirements, does that force a broadening out of those assets? I mean, as Jamie Dimon has said, his non-bank competitors will be dancing in the streets, but what about the smaller bank competitors?
Well, I don't think that the smaller bank competitors will really have the capacity to significantly increase their lending. But I fully agree with Jamie Dimon. It's you're taking a chance whenever you disagree with him, since he's so often right, that there will be a migration to the non-bank lenders who have no capital requirements at all as a regulatory matter.
Raj, since we have you, just one last question. What else should we be looking out there on the regulatory landscape when it comes to banks?
Well, let me mention two. Number one, there's also a long-term debt proposal, which would be particularly difficult for the so-called Category 3 and 4 banks, those with $100 to $700 billion in assets, that would be a real earnings eater. And the second is the overall supervisory situation. There's been very little recognition of what the Federal Reserve said the week before last in its semi-annual review of the state of the banking industry. And the particularly pertinent comment is that 2/3 of the banks with 100 billion or more in assets, that 4/5 of the entire asset pool of the banking system, have an unsatisfactory rating in at least one of the three component pieces. And I think that has got to be an all-time high, except maybe in 2008 and 2009.